Welcome to a new episode of the Opening Bid Podcast. I'm Yahoo Finance Executive Editor Brian Sozzi. Like I always say, this is the podcast that will make you a smarter investor, period. And of course, Opening Bid sponsored by our friends at Vanguard. So my friends that know me pretty well, they know that I love me some activist investing. I love activist investors that roll up their sleeves and get the job done. That's why my sleeves are rolled up for this one. They're crunching numbers and they're challenging management teams and boards. And one of the activist firms that I've been following for some time is the team over at Arkhouse. I originally came in touch with them for their work on Macys. They tried to take this company private for almost $7 billion. Thought the company was undervalued. Of course, Macys owns a lot of real estate. But that's how I came across for the first time the Arkhouse story. Now they're back here challenging another company you know very well, that is IAC, led by media mogul billionaire that is Diller. Let's bring in the main guy here, Gabriels. Kahana, good to see you.
Great to see you, Brian.
From Macys to IAC. I mean, from a real estate play, you guys normally specialize in retail. Now you're going into old media. Why? Why is that?
Yeah. Well, we were incredibly distracted by the wild undervaluation of their assets, and that's really what is interesting to us generally. Similarly, as in the case of Macys, we recognized just a huge mispricing of assets that you really don't need to be a media expert to get your head around.
So how big, IAC, created by Diller, big time media mogul, owns over 40 brands. People is one of them. Stakes in MGM, Turo, the rental car company. What do you see as undervalued in this business?
Yeah, well, I think we see it as one of the most compelling risk-adjusted opportunities in the public market today because of the undervaluation. And there are, I would say, sort of two ways to skin the cat. There are thousands of ways, but two really simple ways to come at this. You're either buying Turo, like you mentioned, Care.com, Dotdash Meredith, that owns,
It's like 150 million viewers, visitors a month, or some crazy number.
Wild eyeballs, great brands, for free on the basis of MGM and cash. So in other words, IAC is trading today, its share price is trading at the value of its liquid assets alone. We're talking about US denominated dollars, unrestricted cash, and MGM. I also, as an aside, think MGM is tremendously undervalued, and we could talk about that a little bit. But just for its cash and stake in MGM, 22.5% stake in MGM, you can go in and buy those assets at cost and get the rest of that stuff that we just discussed for free. And we think that represents a 50% or so discount to true value. And to your, I want to reframe. I hate to force you to roll your sleeves back down, but I want to reframe the way you characterized our engagement with them. We're really not challenging Barry Diller. We are very much cooperating with the guy and are really thrilled that he's been engaged so constructively. And I would say somewhat surprised that it's been such a cooperative and fruitful engagement thus far.
What's the difference between, there are essentially two types of activist investing. I mean, to your point, you have one that these boards and management teams want to work together and deliver your ideas. And then other firms that are so entrenched and challenge you. Like, how do you overcome those management teams?
Yeah. Well, we try not to. I would say, interestingly, we'll own the name activist, the description activist, because we do activism. We use activism tools and tactics. We do, for sure. But I would say, unlike other activists, we're really not drawn to the fight. I'm a pacifist, dude. You can, I walked into the room. You could size me up. You could take me on. Anyone could. I'm not really feigning for the fight. I find activists are often sort of like moth to a flame in that way. So when we see an entrenched board or bad governance, those aren't things that attract us. For other activists, it's fodder for the fight. I get to say that, this CEO is terrible and he's misusing corporate funds, and, this director is embezzling money or what. We don't like that. That's a problem. We want to get into companies.
It's a problem you may not be able to fix.
Yeah, exactly. That's really unattractive to us. And in this case, I think actually interestingly, there is still, and this is something that we are excited to correct, a perception, I think it's been dislodged a little bit, in the company adding Tor Bram to their board, a director that we encourage them to interview and consider. There is a misperception that this is in, autocracy, where Barry Diller, reigns supreme and no one else is listened to, no one else has a voice, shareholders are sitting in the backseat, and that's really not the case, notwithstanding their dual class structure.
How did you, before I even get to my next question, I want to walk through some of the valuation, how you arrive to your number. How do you wake up one day and say, I want to challenge a Barry Diller? From the outside looking in, this is a media mogul, worth a lot by all indications and past interviews, pretty intimidating dude. Like, how did you even come to say, going after IAC here? We want to do something with this company.
Well, again, it was really sort of a bottoms-up underwriting and analysis of this asset, these assets, and a concern was, well, we don't really want to go up against Barry Diller, and then we realized we don't really have to go up against Barry Diller. We don't need to fight an entrenched manager here because that's not what we're dealing with. So I would say it was not an active decision to fight him. It was an active decision to invest alongside him and make money with him.
So you got the board member, check done. Now you see IAC's assets could be worth upwards of $72 a share. Walk us through how you get to the number. What has to happen to drive that type of value?
Yeah, so they could be worth a whole heck of a lot more. The $72 a share is really just taking the value of cash, which is, I'm not a valuation expert. But
well, they have $1.2 billion of cash on the balance sheet. They own 20% of MGM. The market cap's what, $3.2 billion or so? Somewhere there's a disconnect. Like something's wrong.
Yeah. Oh, 100%. So MGM plus cash alone, again, you get to the high 30s number, and then Dotdash Meredith. We are holding at cost. And that is a story of significant improvement and really great asset value and tremendous cash flow. I mean, their EBITDA there, exceeds $300 million. Goldman Sachs recently put a 10x or so on forward EBITDA valuation, implying $3.9 billion. That would give you an additional $30 or so a share. We are holding it closer to 20, again, like cost. Then you have Care.com. Turo, together another in excess of $10 a share. Then you have Vivian, valued by Thoma Bravo for another, $4 a share. You have their headquarters, which is a gorgeous building on, By the way, you said we're not a real estate investor. Well, of course we are. We're
so is that the play you're after the headquarters?
Yeah, we're after those $3 a share.
Yeah, just like that Macys Herald Square. Maybe
we can talk about that as well. It is a nice shiny object, but it's not really driving the sort of underlying mispricing here.
So where, now that you've had these conversations, you've got your board member, you've had conversations with Barry, I imagine. What is he inclined, you think, to do next? Does he want to break up this company further?
He's always wanted to break up his company, right? He describes it himself as the anti-conglomerate conglomerate. And I think what he means by that, and I know what he means by that, is that he seeks to incubate and then spin, once grown to maturity, great companies. And he's done it. He has a really great track record at doing it. Angie most recently.
Expedia.
But before that, Expedia, Vimeo, Ticketmaster, really great businesses. And by the way, during his tenure doing that for 2 decades, his shareholder returns exceeded those of Berkshire Hathaway's. And yet, here we are sitting today with him resuming the helm of this company, and they're trading at half off. Berkshire Hathaway, not really trading at half off, maybe the opposite.
Yeah.
And that's weird, right? That doesn't make a lot of sense. And we seek to make dollars where things don't make sense.
So
that's
good. That is pretty good.
It would be terrible if I had thought of that. Like if I had said that previously, that actually just came.
So
out.
he's 80. Barry Diller's 83 years old.
Yeah.
Came back to lead the company earlier this year. When does he start executing on what looks to be his final act? Not to get depressing. I'm not talking about it from that perspective. When did we see a release from him? We're spinning off Dotdash Meredith. We're selling it to another media company. Like, when do those things start to happen, you think?
I'm not his general practitioner, so I'm not going to, actuary him. But I would say it is unsurprising to me that he is retaking the wheel right now. He started executing, after our engagement, on $4.5 million share buybacks, 4.5 million shares bought back. He has another 9 million or so authorized. So he is actively going to do things, and he's actively started doing things that we think are going to collapse the dislocation between intrinsic value and the current share price.
What in the range of things that could happen first? Is it Dotdash Meredith, given that's one of the biggest publications he has, or collection of media assets? Is it monetizing the stake in MGM, or is it monetizing the stake in Toro, or is it all three? And it could happen this year.
We're, of course, very deferential to management at the company to make great decisions on behalf of shareholders. All of those things are possible. I would say DDM is a very attractive asset to private equity. Very cash flow generative. It's a little more confusing to the public market, though I think there are opportunities for them to go and make strategic add-on acquisitions to that business that could really help to unlock public markets value for that asset. MGM, similarly mispriced, and a really interesting opportunity for future value unlock. Right now it's kind of sitting in a neither here nor there position where they own, less than a quarter of the company and don't consolidate the company's P&L onto their own balance sheet, which means that it just flies under the Bloomberg radar. It just all these passive investors, quants trading, moving the market, are not appreciating that you own 25% of a very EBITDA generative, super high yielding growth company.
Hang with us, Gabriel. We're going to go off for a quick break. We'll be right back on Opening Bid. Welcome back to Opening Bids, of course, sponsored by our friends at Vanguard. Having a fun chat here with Gabriel Kahana over at Arkhouse, managing partner and co-founder, really digging into his thesis on IAC, why he's working with billionaire business mogul Barry Diller, not challenging him. Why are activists
for now?
I mean, do you want to challenge him?
No.
Mr. Diller, do your thing, right?
Oh yeah, absolutely. For now.
Okay.
I would say the way we think about it is we are thrilled that this company has governance such that shareholders can take action if necessary, and to the extent necessary, we will take additional action.
Is the board an inhibitor to driving real change? And I ask that because he owns 43% of the voting power. His wife, partner, Diane von Furstenberg's on the board. His stepson, Alex von Furstenberg's on the board. He's on the board. Even Chelsea Clinton, longtime board member at IAC. Is this the right board to drive big change? I guess is what I'm getting at.
So I think it is the right board now that Tor Bram has joined. I would note that with respect to his 43% voting control, that only applies to once 9 of the 12, now fewer, directors. So a number of the directors, and this is like a kind of, I don't mean to nerd out on governance now, but a number of the directors on the board are elected by the common holders and the common holders alone, separate and apart from the Class A, and that's where Barry gets his sort of super voting power from.
And if you want to learn more on what Gabriel's talking about, just pull the 10K. Go to sec.gov and read up this stuff. How do you think I learned this stuff? I'm a former analyst. I go to sec.gov, type in IAC, and you can read about this yourself.
Or call Brian's cell phone
here
at
1-5. Yeah, no, totally. But I want to get, I'm getting into Macys. But before I do, how did you get into activist investing? Like, why is this your jam, so to speak?
So our investment team is predominantly made up of private equity oriented investors, analysts that really cut their teeth buying and selling mostly real estate, but not exclusively, assets in the private markets. And a couple years ago, my managing partner and I, John Blackwell, recognized just a really weird dislocation in value between the public and private markets, mostly for real estate. And in today's environment of really unprecedented opacity, and this I think really into the future, like just an inability to see what is going to happen next, and the results behind that door could vary so wildly. And I think that dynamic really started to unfold and was exacerbated in the beginnings of COVID, but it's continued and persisted. It is really not fun to be whipsawed around by macro events you have no control over, right? Like tariffs, right? That's a hot topic today. Geopolitical tensions, interest rates, where are they going to go? What we love about our strategy is we're invested in situations where the public markets are deeply discounting a collection of assets that private equity values much higher. And that disconnect persists whether rates are at 2 or 4 or 10 or 20%. So we're really just looking to ride that collapsing of dislocation and catalyzing that collapse of dislocation between public value and private equity value, or what we would call intrinsic or true value. And I don't mean to cast aspersions on public markets investors. Maybe they're right. Maybe private equity is wrong. Who knows? Either way, we want to collapse that. We want to buy for 10 and sell to PE for 20. And that's effectively the goal. And it started with real estate, and then we realized this kind of persists more generally. And again, I don't mean to go down a rabbit hole. I'll go wherever you want me to go. But like the public markets, shareholder dynamics, the demographics of investors making up the decision-making processes of the public market has really shifted over the last couple decades.
I want to get into Macys a little bit. Macys is a company that I covered. I used to cover as an analyst, maybe 7 or 8 years. It's a story we covered very closely here at Yahoo Finance when you were trying to buy the company with Brigade. Shout out to our senior reporter, Brooke De Palma. Loved her coverage of it. Really fascinating stuff.
And yours.
Thank you. I appreciate it. Thank you. Thank you. Your final offer in, the summer of 2024, was almost $6.9 billion, you and Brigade. This company's market cap is now $3.1 billion or somewhere around there. Are you happy that you can get this deal done?
No.
No.
No, I'm frustrated as as I think the rest of or most shareholders are. Obviously, woulda, shoulda, coulda. At mid-20s, the stock's trading in the low teens once again.
Are you still a shareholder in Macys?
No comment.
Okay, fair enough. I get it. I get that. We all follow. We got legal stuff here. I mean, but what has to happen to that company? I just look at the Herald Square location in New York City. And you know this, but there's been some estimates that this alone is worth $1 billion. There's clearly some type of major.
I thought you were going to say 4, by the way, and I was going to have to talk you down off because I've heard some pretty wild numbers.
That would be wild.
Yeah, 4 would be wild. $1 billion, I think it's worth more than $1 billion.
Really?
Yeah.
I mean, Macys, the current team is sitting over.
It could be worth more than $1 billion.
But massive value destruction. Here you had. And just to be clear, they made the case you didn't have financing. Did you have financing to do the deal?
Very much had financing. And they actually didn't make the case that we didn't have financing in the end.
They just put out a
because
press
that
release.
would have been just, baldly untrue. What they did say was that our financing was atypical. And on that, they weren't entirely wrong. We did present 2 financing structures, one of which was really real estate diligence dependent. And they said, hey, this is a normal way corporate transaction. Come with traditional corporate financing that doesn't require that we give you access to our department stores to go and do environmental checks. And our response was, we appreciate that you think you're selling just a retail business. But as buyer, we're buying a retailer and 100 million square feet of its real estate, and therefore need real estate diligence in the normal course. And our only outs under the contract that we're looking for are related to that very narrow, specific carve out.
Are they still worth $6.9 billion?
No comment.
Yeah. Well, I mean, this is a company that has been. Well, maybe I'll ask it another way. Is this, if they don't change something? I mean, they've really stayed true to their bold new forward plan or whatever the CEO is calling it.
Bold new chapter.
Bold new chapter. Is Macys the next Sears?
I don't know. I left my crystal ball at home, but I would say that there is a very corpse-ridden path of retailers that didn't take private equity bids when they could have and should have for the sake of their shareholders.
You see that disaster over at Kohl's?
What?
You see the disaster over at Kohl's?
Which one?
Kohl's, I mean, with the CEO getting ousted
Oh,
for some wacky behavior. Would you ever shake trees at that company? I've been covering Kohl's is a disaster.
Yeah.
It's a disaster. Like, is there anything attractive to you about a Kohl's?
Yeah, I mean, many of these department stores have asset value. The question is, like, what does it matter to the public market until someone realizes that asset value, right? Like Sears you used as an example, like, and it's true of JCPenney too. Like, they will nurse their asset value to keep themselves alive. They will drain the asset value, I should say, to sustain the otherwise dying business. And that's just a slow death spiral. And our view is, like, to the extent these companies, and I'm not talking about any specifically in this case, but I do think it is true that they are facing unfair, and we could talk about why they're unfair, headwinds from the likes of Amazon. But to the extent those headwinds persist, and I don't see them abating anytime soon, these guys are dying a slow death.
Well, there's still two people that Arkhouse appointed to Macys' board. They're still on the board.
They are.
Are you done? Are you done shaking trees at Macys?
Again, no comment.
Okay.
No, but come around a different way. I might get.
I mean, do you want it? I mean, are you just done engaging with Macys? I mean,
I want to answer differently.
Well, yeah, well, go. How would you answer? How would you put it? How would you put the situation?
Comment none I have.
Okay, fair enough. I mean, but all right, we'll leave it there. Let me get your hot take. We always.
I think what I would say is Macys is still publicly traded, still mispriced, and still in desperate need of someone coming in to save shareholders.
Macys, give this guy a call. All right, we'll leave. Let's get the hot take from Gabriel here. We were talking about activist investing. Now, I think maybe me and you are around the same age. We grew up thinking activist investing are these corporate raiders. You know, they have these big ass personalities. Yeah. They're going to come. They're going to take your home and fire the board. But you don't.
Well, you told me I couldn't smoke a cigar.
Yeah, but you don't sound like that guy. I mean, of course, I imagine you're a very competitive person. You want to win. You want to make lots of money, and all those things are okay. But it seems like you're different than the generation that you and I grew up with watching an activist investing. Is that just outdated and that model can't work anymore?
I don't know. I think there's room for, pugnacious, bombastic people to make money, as there are, people just looking for everyone to be happy, which, I think I fall into the latter camp a little bit more. But I again, like, we didn't say, hey, what would be cool if we went to start an activism fund. That was not the genesis of Arkhouse at all. In fact, we really kind of bumped into it or backed into it and looked over our shoulder and realized, oh shoot, we're activists. Didn't realize that or didn't intend for that outcome. So in many ways, I think that the sort of persona that comes along with it is not anathema, but somewhat alien to us.
Someone's got to pick up the mantle from Bill Ackman. I talked to him at Milken last week, and he's trying to be the next Warren Buffett, and that's not an activist. I mean, somebody's got to pick that torch. Maybe you're that torch guy.
Yeah. Well, maybe the new version of Warren Buffett includes someone telling CEOs of companies hey, you actually need to do this because I'm a shareholder.
Yeah.
Right. In other words, Warren Buffett, I wouldn't say it's not that he wasn't an activist. Look at what he did with the Washington Post. He just said, hey, I want to own a lot of your company. I want to work with you. I do not want to unseat directors. And what was it? The famous letter to Graham.
Yeah.
He said, it's your company. It's Graham controlled and Graham owned, and that's fine by me.
Yeah.
But he did acknowledge that as a shareholder, he does wield that stick. And I don't think it was. Maybe it was never made explicit by him, but I don't think it wasn't on the table sitting there quietly implied.
Mm-hmm. We're going to leave it there. Fascinating conversation here. Gabriel Kahana, Arkhouse managing partner and co-founder. Keep me posted on that, Macys.
For sure.
All right. Of course, Opening Bid sponsored by our friends at Vanguard. Continue to hit us with all those thumbs up and likes on all the podcast platforms and YouTube. Love all your comments. Love all your feedback. It makes me a better interviewer and makes me better doing what I do all the time, which is talk to interesting people like Gabriel. We'll talk to you soon.